Welcome to today's fundamentals. Hello, Peter.
Hello.
So what are the latest updates about the situation in Israel?
Well, we know that practically it seems that the situation on the Israeli side seems to be stabilizing somewhat, in the sense that the Israeli side has locked in the Palestinians in the Gaza Strip. But overall, I would be noting here that market expectations, despite pushing oil prices a little bit higher during Monday's Asian session, seem to be easing, especially during today's Asian session. So overall, we saw some correction in oil prices lower. I would be noting that overall the market words seem to be easing, and there is a sense that the situation has started to come under the control, which more or less implies more stabilization to come. Now, the big issue about the conflict in Israel is whether that's going to be escalating or not. And in the case of, say, for example, a possible land operation by the Israeli Defense Forces, we may see some escalation with more casualties, especially in the civilian side. I would, though, highlight the possibility that we see neighboring countries actually not intervening, but raising the bars or the bets a little bit. Say, for example, we may see some announcements from Egypt or from the Saudi Arabians. Should that be the case, that could have some wider repercussions in the market.
And how's the USD been moving?
Well, the USD edged lower. Actually, it dropped across the board yesterday. I would be noting that analysts have highlighted comments from Fed policymakers, among which would be Dallas Fed President Logan, where she stated that practically the high yields of US bonds may more or less prevent the Fed from actually hiking rates once again. We have to note here, though, that US bonds in the past 24 hours have been in high demand, and yields have started to drop once again as market has shifted towards safe haven instruments. I would expect that should we see more Fed policymakers actually promoting a shift in the Fed's hawkish rhetoric, we may see the USD weakening even further.
And how have US stock markets been behaving?
We saw some support, but overall the big question here is, in my opinion, the fundamentals surrounding US stock markets. And at this point, I would be highlighting that we are at the beginning of the earnings season once again. Q3 has ended. I would expect a shift of attention towards US equities, as we're going to be seeing headlines reeling in from high-profile companies releasing their earnings reports. We could make a start with big banks on Friday, among which, if I'm correct, is Wells Fargo, and I would be also noting Citigroup. So overall, we may see some more attention being drawn towards US stock markets, which may increase volatility as well.
And back in the FX market, what's on the calendar for today?
Well, we had some releases during today's European session. Ahead of us, I would be noting a number of speakers. First of all, we have ECB President Christine Lagarde. Now, should she sound a little bit more on the hawkish side, we may see some support for the euro. From the US side, I would be noting in the American session Atlanta Fed President Bostic, but I would mostly be highlighting Minneapolis Fed President Neil Kashkari. He leans more on the hawkish side. So any comments he makes today, should they be in contrast to comments made by Jefferson Logan yesterday, that could shift the market sentiment and increase market risk for a possible rate hike by the Fed, which could provide some support for the USD. During tomorrow's Asian session, we get San Francisco Fed President Daly. Ms. Daly more or less tended to lean more on the dovish side, so I wouldn't expect much there. And for Aussie traders, I would be highlighting the consumer confidence for October of Australia, as well as Assistant Governor Kent's speech a little bit later. The interesting part here is that the Aussie tended to gain against the US dollar in the past 24 hours, despite actually the business confidence and business conditions in Australia deteriorating over the past month. But it seems that there was a wider improvement of the market sentiment, which tended to provide more support to the commodity currency and thus allowed it to rise.
And how about the rest of the week?
Well, I would be highlighting 3 releases. The first would be tomorrow, and we are talking about the Fed's meeting minutes of the September meeting. Now, should the document lean more on the hawkish side, say for example, be supporting the notion that Fed Chairman Powell had expressed in the press conference following the meeting that one more rate hike may lay ahead for the Fed, that could provide some support for the USD. And on Thursday, we are noting the release of the US CPI rates for September. Should the rates accelerate or even fail to slow down, that would imply continuance of inflationary pressures and may turn the Fed a little bit more hawkish, especially given that we had a better than expected NFP figure on Friday for September of the US employment report. And I would be also noting from China during Friday's Asian session, the trade data for September. Now the trade balance is expected to be a surplus and actually to widen a little bit. And that would be a positive for the CNY. But I would be also focusing on the import growth rate.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
So welcome to the technical analysis part of the presentation. Once again, my name is Peter Iosif, Senior Market Analyst at IronFX. In front of your screens, you have the Euro USD. It's the 4-hour chart. All charts to be presented are to be of the same time frame unless otherwise stated. Please mind that we have recalibrated the resistance lines of Euro USD a little bit to the upside in order to better reflect the peaks of the price action. And we have set the R1 at 1.0635. I would be highlighting also here that we have an upward movement of the pair. Interestingly enough, it may present some resistance a little bit lower. To 1.0615. That should be better. Note how that catches this peak here, but at the same time, these support points. So let's lower the label as well and correct it. That's it. Now, there seems to be a bullish sentiment being built up, given that the RSI indicator has risen. Actually, it's currently at 62.2, which could be perceived a little bit bullish. So the market sentiment seems to be pushing Euro USD higher, but mind you that we had consecutive higher shows and consecutive higher peaks, but the last peak was not able to differ substantially from the previous one. So on the one hand, we have the upward trend line supporting the upward movement of Euro USD. Yet for a clear-cut bullish outlook, I would require the pair to clearly breach the R1 1.0615 and start aim for the 1.0770. On the flip side, should the pair stabilize, I would expect it to correct lower, break the pre-mentioned upward trend line, yet remain between the 1.0615 resistance line and the 1.0460 support line. Should the bears take over, however remote that may sound, it's still a possibility and should be covered. We may see the pair dropping, breaking the pre-mentioned upward trend line, once again, first signal that the upward movement has been interrupted. But for a bearish outlook, I would require a lower draw than this one. So the pair has to break below the S1 1.0460. Okay, let's have a look. Give me a sec. Okay, let's zoom it out a little bit. Move to GBP US dollar. That's it. Now, GBP USD has clearly been on the rise. It's actually currently testing the 1.2260. It's going to be interesting to see whether the level is going to be providing support and pushing the pair higher. I would definitely highlight the upward movement. It's very similar to Euro USD. Should the pair actually maintain the bullish outlook, I would be surprised to see it breaking the 1.2260 and start aiming for the 1.2375. A possible stabilization with the R1 being the upper boundary or even an axis around which the price action may revolve would lead the price action to actually break the pre-mentioned upward trend line and stabilize. On the flip side, a bearish outlook would imply practically that the pair has to drop, break the pre-mentioned upward trend line, but also breach the S1 1.2065, a level which was marked here. Overall, though, for the time being, we tend to maintain a bullish outlook given the upward trend line, given the RSI indicator, which remains at the reading of 61 almost. And also note how the Bollinger Bands are pointing upwards, while the moving averages, specifically, we're talking about the 100 and the 50 moving average, have started to shift from their downward slope. I would advise some caution here, though, that the price action seems to be hitting on the upper Bollinger Band, which may slow down the bulls a little bit or even cause it to contract a little bit lower. Okay, let's have a look at the next pair, USD JPY. USD JPY maintained a sideways motion. That's pretty clear. And I would be highlighting that in contrast, say, for example, with the euro and the pound, which took advantage of the dollar's weakening. JPY seems to be weakening with it and actually was not able to capitalize on that. So we tend to maintain our bias for the sideways motion to continue. It's characteristic that the RSI is running along just below the reading of 50, implying a rather indecisive market, which more or less may allow the sideways motion between the S148.40 and the 149.90 to continue. Should the bulls take over, I would expect the price action to rise, break the R1 149.90, and start aiming for the 151.90. But it's a very, very wide step. A bearish outlook, which may also be in the cards, say for example, if the USD side of the pair decides to weaken even further, could lead USD/JPY below the S148.40, which was marked once, twice. While even lower, we note the S247.50, which was tested once, twice, 3 times here. And even lower than the S2, we note the 146.20, which was tested here. Okay, let's have a look then at the Aussie. The Aussie was able to rise and break clearly the 0.6380. Some may have discussed here also 0.64 as being a possible resistance line. Allow me to have a look. I could also be acting. We're talking in the same range, but in any case, this level has now to be turned into a support line. And let's go hunting for a new ultimate resistance line. Unlocking the chart, going back. It's a little bit wide, but it's a very interesting peak here. And was also tested to the downside. So this level seems to be pretty valid. And that would be, give me a sec, in red, the 0.6725 resistance line. Let's readjust the chart. Let's reposition the labels and correct them as we have shifted to the upside. Okay, let's start with the S3, which is now being placed at 0.6170. The S2 at 0.6285. The S3, sorry, the S1 at 0.6380. The first resistance line being set practically on these peaks here, 1, 2, 3, and aimed for here 4. And that's 0.6510. The R2 at 0.6610. And the R3 at 0.6725. So we tend to maintain a bullish outlook, given that the upward trend line guiding the pair seems to remain intact. It was characteristic that it was briefly breached on Friday and tested again on Monday, but note how it has provided support practically during today's European session, allowing the pair to advance higher. I wouldn't be surprised to see AUD/USD start aiming for the 0.6510. Now, there are some which tend to argue And that's one possibility, that there may be another resistance line here or here or here. I'm going all the way. And that would allow practically for 130 pips corridor to emerge between the R1 and the S1. Quite beautiful. Now, should the pair stabilize, in contrast to our bullish outlook, which is also a possibility, we may see it remaining rather stable just above the S1 0.6380 and actually breaching the upward trend line in a signal that, first signal, that the upward movement has been interrupted. For bearish outlook, I would require the pair to break the prementioned upward trend line, once again signaling the ending of the upward movement. But also I would require the pair to break the S1 0.6380 and start actively aiming for the S2 0.6285. Such a movement may also allow us to start drawing or mapping out at least a possible downward trend line, showing us exactly any possible limitations of the downward movement. Okay, let's move to USD CAD. It's very similar to the Aussie, only in the reverse. The USD CAD has broken the 1.36 support line. Now we have to turn it into a resistance line. Let's go hunting for a new ultimate resistance level. Sorry, support level. Be noting this show here. It's, I think, very characteristic. Let's color this in green. $1.30 with 3.15. Could go to 20. Let's have a look. Yep, 20 it is. Readjusting the chart. Zooming out a little bit. Starting with the labels and the R3, which is now being placed at 1.3775. Let's reposition the labels. Here you go. The R2, which is now being placed at 1.3690. The R1 at 1.36. The S1 at 1.35. The S2 at 1.34. And the S3 at 1.3320. A little bit narrow, but still. So there's a clear-cut downward trend line, still guiding the pair. We tend to maintain a bearish outlook. I wouldn't be surprised to see the pair actually hitting a ceiling at the downward trend line and continuing lower once again. That would imply practically that the 1.36 resistance line now has to hold its ground for the bearish outlook to have any chance. Should the R1 though hold its level and its ground and remain a valid resistance line, but at the same time we see that the price action breaks the prementioned downward trend line, and we're talking about the next 24 hours here, then that may lead to a switching of the bearish outlook in favor of a sideways movement bias. Now, for bullish outlook, I would require the pair to rise, break the prementioned downward trend line, exactly highlighting that the downward movement has ended. Also break the 1.36 resistance line and start actively aiming, if not reaching, the 1.3690. Now, we can say that some people have mentioned the possibility that the R2 may be a little bit too wide off from the R1. We're talking about 90 pips for USD CAD. It's feasible easily within 24 hours. Note how the RSI indicator is pretty low. It's actually at the reading of 36.5, implying a rather bearish sentiment. Yet, on the other hand, we have to note that the RSI indicator had hit the level of 30 and is correcting slightly higher, sorry, implying more or less that the bearish sentiment may be slightly easing. Nevertheless, for the time being, we tend to maintain our bearish outlook, and as long as the downward trend line remains intact, or even may shift a little bit to the right, that shouldn't be an issue. It's still bearish. Okay, let's have a look. I would like to have a look at oil prices. Give me a sec. Hello, Christopher. And Aslan. Nice to see your comments. Anyways, let's have a look at WTI. Now, WTI's price action, we note three elements here. The first element is, allow me first of all to narrow the lines a little bit too intense for my taste. Okay, the second element which we have to note here is that the R1 has been breached, so that has to be turned into support line. Let's also correct the labels. Starting with the S3 at 78.20, the S2 at 81.40, the S1 at 84.30, the R1 at 87, the R2 at 90.40, and the R3 at 93.60. That's it. So we have to highlight 5 elements here. The first element is there seemed to be a fatigue of oil bears in Friday's late American session. You can see it on these two last candlesticks of the American session on Friday. which characterized a slight reversal of the previous day, allowing the price of oil of WTI to actually stabilize somewhat. That's one. The second element would be the substantial positive gap which was presented during Monday's Asian session, and that was attributed clearly to the conflict in Israel, given that there were substantial market worries at Monday's Asian opening that we could see some intervention on behalf of Saudi Arabia cutting oil production even further. That pushed the price of oil higher. And please note that the third element here is the breaking of the downward trend line, with the fourth element being the stabilization of WTI's price just above the 84.30 support line. Mind you, fifth element, that the RSI indicator continues to run along the reading of 50, implying a rather indecisive market. It's as if the market here maintains a wait-and-see position. So in our opinion, for the time being, we tend to maintain a bias for the sideways motion to continue just above the S1 84.30. Now, should the bulls take over, we may see the price action of WTI rising, breaking the 87 resistance line, and start aiming for the 90.40. On the other hand, should the bears take over, I wouldn't be surprised to see the price action of WTI breaking the 84.30 once again below it, and aim, if not even breach the 81.40 support level. Let's have also a look at gold's price. Okay, gold's price seems to have hit the ceiling at the 1865 resistance line. That seems to be pretty valid right now. The question here is whether the upward trend line or the upward movement has been interrupted or not. It seems to be the case. Let's have a look at that. Yep. And I think that would become more obvious in the 1 hour chart. Yeah, it definitely was. Note the jump, the positive gap here, which was created practically at Monday's opening. Back to the 4 hour chart. Once again, quite impressive. And may have more or less being instigated by the Israeli conflict, given the uncertainty created in the market and higher demand as a safe haven for gold. For the time being, though, we note that gold's price has hit the ceiling at the 1865 resistance line and seems to have interrupted its upward movement, more or less allowing us to switch our bullish outlook in favor of a sideways motion bias. There is a catch here. And the catch is that despite a slight drop of the RSI indicator after hitting the reading of 70, actually surpassing it slightly, it seems to be inching lower, implying that the bullish sentiment for gold of the market seems to be fading away. For the time being, it's at 64.5, which is pretty high, but it's dropping. So there may be still some bullish tendencies left in the market sentiment, which could drive gold's price higher. And when we're talking about the bulls taking over here, I wouldn't be surprised to see gold's price breaking the 1865 resistance line and aim, if not even breach, the 1900 resistance level, a level which used to be a support line, yet has now been turned into a resistance line given that the price action is below it. On the other hand, should we see a full blown out bearish outlook, we would require the pair to drop, break the S1 1819, and start aiming for the S2 1785, nothing less. It's going to be interesting in the following sense that the relative stabilization which gold's price had presented over the past week has now ended, and note how the Bollinger Bands have widened and turned to the upside. That's a clear indication for an intense bullish movement, and actually, that's another catch. Note how the price action of gold corrected lower in the past 24 hours after flirting with the upper Bollinger Band. I think that's also characteristic, and now that more or less some distance was created between the price action and the upper Bollinger Band, that may allow the bulls some room to play. Once again, though, for the time being, we tend to highlight the possibility of a sideways motion, possibly in the corridor between the R1 and the S1, yet the bullish tendencies may still be present, so do not get surprised should gold's price be able to breach above the R1 1865 and start aiming for the 1900 resistance level. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Everyone, my name is Emily. In today's session, we will look at news trading on economic releases. This trading strategy is appealing to many short-term forex traders. As markets move because of news, the release of economic data is often the most important catalyst for short-term movements. Basically, this trading strategy involves trading around significant forex news events, such as key economic releases from the countries whose national currencies consist of the major currency pairs. Because of the strong influence on a currency's valuation, a forex trader can take advantage of an important news release to potentially benefit from those fluctuations. There are 8 major currencies available for trading, so there is always a piece of economic data scheduled for release that forex traders can use to make informed trades. 7 or more pieces of data are released almost each weekday, except from holidays, from the 8 major most followed countries. Therefore, for traders who choose to trade news, there are lots of opportunities. As the US dollar is on the other side of 90% of all currency trades, US economic releases tend to have the most noticeable impact on forex markets. If you want to trade news successfully in the forex market, you need to know when reports are expected and understand which releases are most important under the economic conditions at the time. Generally, the most important information relates to changes in interest rates, inflation, and economic growth, like retail sales, manufacturing, and industrial production. To sum up, it's important to do your research and stay on top of economic news in order to reap the rewards. Thank you so much for watching us today, guys. Bye-bye.
Okay, I think we can go ahead and get started now. So hi everyone, welcome to today's webinar. So for today's session, we're going to be talking about the 7 common mistakes that new traders make. I'm Melanie and I will be your speaker for today. Just a disclaimer as per usual. Information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. Material in this webinar is just the personal opinion of the author, and the client's investment objective and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so hi everyone, I'm Melanie and I'll be your speaker for today. I'm from the company Everest Fortune Group, who are finalists for Best FX Research and Best Equity Research in 2019, 2020, and 2021. So not to worry, Desmond will be back next week. He just isn't feeling well today, so that's why I'm covering for him. But he'll be back next week, don't worry. Okay, so here's our agenda for today. So firstly, we're going to be talking about not having a trading plan. Secondly, no stop loss. Thirdly, no risk management. Fourth, chasing losses or revenge trading. Number 5, over trading. Number 6, ignoring fundamentals. And number 7, not keeping a trading journal. So for some of these, we will just skim through pretty briefly because some of them are pretty self-explanatory just from me mentioning it. I think it's pretty clear what we mean. And some of them we will get pretty in-depth into, so such as the no stop loss and no risk management. We'll give you some tips on how you can prevent these from happening and how exactly you should manage your trade. So let's dive right in. Throughout the webinar, if you have any questions or anything you'd like to point out, feel free to pop them into the chat, and I'll try and answer them as best as I can. Okay, so not having a trading plan. This is the first mistake that beginner traders make. And having a trading plan is important for several reasons. So over here, firstly, we have consistency. So a trading plan helps you to maintain your consistency in your trading approach because it outlines your trading strategy, including entry and exit criteria, risk management rules, and position sizing. So by following a well-defined plan, you are less likely to make impulsive decisions based on emotions or market noise. Consistency is crucial for long-term success in trading. Next, we have objective decision-making. So a trading plan provides a framework for making objective decisions. So it helps you define specific criteria for entering and exiting trades based on technical or fundamental analysis. So this eliminates guesswork and emotional biases, allowing you to make rational decisions based on predetermined rules. Next, we have risk management. So we'll get a little bit more in depth into this in the next few slides. But basically, a trading plan incorporates risk management principles that help you to protect your capital. So it outlines exactly how much risk you are willing to take on each trade, where to set stop loss orders, when to take profits, so on and so forth. And by implementing proper risk management techniques, you can limit potential losses and preserve your trading capital. Next, we have focus and discipline. So a trading plan keeps you focused on your trading goals and prevents distractions. So it helps you avoid impulsive trades or chasing after hot tips. Following a plan requires discipline and adherence to the rules you have set for yourself. So this is very important as well because to help you to overcome any emotional challenges that come with trading. Next, we have evaluation and improvement. So a trading plan serves as a reference point for evaluating your performance. By keeping a record of your trades and comparing them to your plan, You can identify strengths and weaknesses in your trading strategy. So this allows you to make informed adjustments and continuously improve your trading approach over time. And lastly, we have confidence. So a well-defined trading plan gives you confidence in your trading decisions. It provides a structured framework and a set of rules to follow, which will help you to reduce uncertainty and anxiety. So when you have confidence in your plan, you're more likely to stick to it during challenging market conditions and avoid making impulsive or emotional decisions. Okay. No stop loss. Okay, so let's get right into it. So the next few slides, we're going to be pretty in-depth in it's gonna be pretty in-depth into how exactly you can manage your trade. Okay, so first, in order to manage a trade, it's first important to understand what a trade consists of. So you can attend our trade management series, but I've basically I'll briefly be covering all of what we go through during the trading management series in this webinar. So let's look at anatomy of a trade. Firstly, it consists of the entry, stop loss orders, and take profit orders. And how exactly you can manage these trades would be through a break-even, partial profit, idea invalidation, trading stop loss, as well as diversification. So this is what we cover during our trade management series, but I'll just briefly go through what exactly each of these mean. Okay, so why is it important to have a trade management strategy? Firstly, it helps you control risk. So trade management strategies such as stop loss orders and position sizing help traders to limit their potential losses and manage their overall risk exposure. Secondly is to maximize profits, to lock in profits and maximize returns, such as through your take profit orders and trailing stops. Third, managing emotions. So the discipline and structure that trade management provides can help traders to stay calm and rational even in volatile markets. So this can help prevent impulsive decisions driven by fear or greed. And next, we have improved trade efficiency. So by having a well-defined trade management plan, traders can make more informed decisions and avoid the cost and time of having to constantly monitor and adjust their positions. And lastly, increase consistency, which we've already mentioned earlier. So I'm just going to move on to our next slide, which shows you exactly the problem with a fixed take profit. So let's take a look at this example. The red area shows a strong resistance area since there have been two swing highs in line with this area. If our trading strategy requires us to have a fixed take profit of 100 pips, we will place the target beyond this strong resistance area. And you can see over here, we're expecting price to go up towards that same swing high resistance level. So this is how it played out in the end. Let me show you. This is the before and this is the after. So this is our profit target, and price shot up but missed it by a couple of pips before reversing back down. And the reason for this is because price tends to reverse off of big areas of resistance and support. So in an alternative scenario, if we had placed our take profit before the key resistance level, we would have got a profitable trade. So it's important to look at the charts and then adjust your take profit or stop loss accordingly. Okay, so this is the proper stop loss and take profit placement. Feel free to screenshot this if you'd like. The proper stop loss and take profit placement ensures you maximize your wins and minimizes your losses. So the stop loss should always be placed beyond the resistance area, while the take profit should be placed before. So we'll go through a couple more examples in the next few slides. So here we have trade management with FIB confluence, but this is basically applicable for any kind of area that we're talking about that involves take profit and stop loss, not just for Fibonacci. Okay, so stop loss beyond means you should always put your stop loss beyond a key confluence area, or as we mentioned earlier, a key support or even resistance area. And the reason for this is because more often than not, price is attracted to such strong areas of confluence, and if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So this is one of the reasons why most people wonder why they got stopped out right when the market starts to reverse. So now let's take a look at take profit. So take profit target before a key Fibonacci confluence area. So it means that you should always put your take profit target before a key area. And the reason for this is because when price reaches the Fibonacci or support and resistance area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry or even your stop loss. So this is also one of the reasons why people complain that the market is being manipulated because they miss their take profit by 1 pip. So here's an example to show you why you shouldn't have a fixed stop loss. Here we have a support level with two swing lows in line with one another. Price has bounced off this support level and we are expecting it to continue to rise to the swing high resistance. Excuse me. So our stop loss of 100 pips is fixed at the 1894.75 level at the support level. But instead of going up, as we expected, price actually goes down instead, and it touches the stop loss and bounces perfectly from the support. So instead, what we should have done is to place our stop loss slightly beyond the key level of support and resistance so that we are not stopped out at the support, as price tends to be attracted to key levels of support or resistance and bounces off of them. Okay, so this is why it's important to have dynamic stop loss and take profit placement. Dynamic stop loss is a trading strategy used to manage risk in which the stop loss is adjusted dynamically based on market conditions. The level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses, and the placement of the stop loss can be determined by various technical analysis indicators or other market conditions such as volatility or market trend. Okay, here's a simple example to demonstrate dynamic stop loss. Price has bounced off nicely off the support level at 86.721, and we expect it to reverse off the entry at 87.819, in line with the 100% Fibonacci projection level. So here you can see we have this confluence area with the negative 27.2% Fibonacci expansion and 61.8% Fibonacci projection. They all line up nicely with our stop loss, and we're expecting price to drop from our entry towards our take profit. So instead of putting our stop loss exactly at the Fibonacci confluence area, we want to move it to beyond it instead, and we'll show you why in the next slide. So you can compare the two. Here we have the stop loss under it, whereas here we want it to be beyond or above. So if we had put our stop loss right at the confluence area, we would have been stopped out. You can see from this little arrow here that we've highlighted. Price is often attracted to strong areas of support and resistance before reversing off of these areas. And you can see after that, it immediately dropped back down as we expected towards our take profit. Okay, so now let's look at another example. So we expect price to bounce off of our entry at 87.625 at the pullback resistance in line with the 78.6% Fibonacci retracement. So we're expecting price to drop from our entry to our take profit. So price has hit our entry and has reversed nicely off of it, heading towards our take profit. So take note, we also have another 78.6% Fibonacci retracement that aligns nicely with our take profit. Okay, so price just touched our take profit before reversing off of it. So this is the before and this is the after. And you can see price really just, with the tail of the candlestick, touch our take profit and hit it back up towards our stop loss. So that's why we always say that the take profit should be placed before any major area of support and resistance or Fibonacci confluence, because it's likely to just touch it and reverse off. And you want to make sure that that price really does touch your take profit before reversing off of it. Okay. So here's one more example. We have this confluence area here at our take profit. And price has recently broken out of this descending trend line, giving us a bullish bias. So we're expecting price to continue to rise from our entry towards our take profit. And you can see here, with our take profit placed above the confluence area, price reversed off of it and missed our take profit by a few pips. So instead of placing it directly here, we want to place it below so that we make sure that price really does touch our take profit. So if we place below our confluence area, price hits our take profit nicely before reversing back down to our entry. Okay, here we have no risk management. This is our third common mistake that new traders make. And I'm combining this with our fourth mistake, which is chasing losses. So chasing losses is also known as revenge trading, which happens when you let your emotions cloud your judgment. So this ties nicely with our first point about having a trading plan and also risk management that I'm going to talk about now. Okay, let's first talk about a break even. So break even in trading refers to the point at which a trade reaches a level where the trader has neither made a profit nor suffered a loss. So it's the point where the cost of the trade, including fees and commissions, is equal to the price at which the trade was executed. So for example, if a trader buys a stock at $100 and sells it at $110, the trader has made a profit of $10. On the other hand, if the trader buys a stock at $100 and sells it at $90, the trader has suffered a loss of $10. However, if the stock is sold at $100, the trader has neither made a profit nor a loss, and the trade has reached its break-even point. So break-even is an important concept in trading because it helps traders to determine the minimum price they need to sell their trades in order to cover the costs and avoid a loss. So this information can be used in deciding when to close a trade and take profits or cut losses. Okay, so here is an example of how we make use of break-even when we are trading. So break-even is a level where you are in profit and recognize that there is a risk of reversal. So here we have an entry at the breakout of the multiple swing high resistance level where we are hoping for price to push to our take profit. So our take profit is here at the green highlighted area. So take note of our original stop loss at 0.2 over here, original stop loss at our swing low support. So at 0.3, at when the break even is triggered, price reaches our break even level and reverses off it. Hence, we move our stop loss to the entry to protect our position. So we move it here instead. Number 4, modified stop loss. So if price continues to our position, that's good. But if price reverses back to our entry, we want to be protected. So here we can see price has broken above the break even, but has quickly reversed and hit our modified stop loss. Okay, here is another concept, partial profit. So partial profits are typically used when there is a strong resistance area and you are unsure if price will rise to your take profit. So you can read the example I've included here, but it's similar in concept to the break even. Okay, so let's look at a couple of examples of partial profit. So here's our first example, which is the Aussie dollar chart. Okay, so on this chart, we have our first support, which is also our entry, and we're expecting price to hit towards our take profit. Okay, so our first support is significant because it has a price has tested this level many times. You can see the swing highs and swing lows, and our stop loss, on the other hand, is slightly below that, and also in line with a couple of swing highs and lows. But if we look at our partial profit, how we chose it is basically at our swing low here. And it's to hit it towards a couple of Fibonacci confluence levels. So we expect price to rise to our take profit, but there is a strong resistance at the Fibonacci confluence area that I mentioned here, which is why we place our partial profit at that area. Okay, so just in case price really doesn't hit our take profit and reverses off of this area instead, we can at least get some profit out of this area. So you can see this is what happened in the end. Price really reversed off of our major confluence area because of the strong resistance area at our partial profit and reversed off it instead of heading towards our take profit. Okay, here's another example. Our entry is here. We're expecting price to hit towards our take profit. Oops. Here's our break even. But you can see, similar to our partial profit example, price shows us that the 23.6% retracement and 38.2% retracement line up nicely with this break-even level. So because of that Fibonacci confluence, we can expect price to reverse off of it, which is why we add a break-even here just in case price reverses off and doesn't hit towards our take profit. So here you can see price at our break-even. And then what do? We adjust our entry to minimize loss. We adjust our stop loss. We put it to our entry to minimize any losses, just in case really price reverses off our break even. And you can see here, luckily we did that because we still made a break even though price didn't hit our take profit and instead reversed off the confluence area towards our stop loss. And in the end, we got stopped out, but without making any losses. Okay, here we have idea invalidation now. So idea invalidation is usually placed before your stop loss. So it's the level which you basically admit, I'm wrong, let me get out ASAP. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So it's a similar concept to what we looked at earlier. But instead of moving our stop loss to our entry, now we're moving our take profit to our entry. Okay, so let's take a look at this example here. Our entry is over here at this multiple swing high. And we're hoping for price to drop all the way down to our take profit target, which is over here. So if we follow price, right, we can see that it reversed off over here and is headed back up. So what we do, we can see it even pushed past our entry, and our stop loss line originally is over here, right? And it's as we mentioned earlier, we want to place it beyond any major area. So since we have a swing high resistance here, we're placing the stop loss beyond that. So it's hit our swing high resistance, but it reversed off of it. So we quickly place our take profit at our entry instead, and we admit that we're wrong and hope that this gets us out of our losing trade. And you can see price immediately reversed off the take profit towards the stop loss. So we do get a break-even profit, even though we would have gotten stopped out if we didn't do this. So at least over here, we get some profits. Okay. So here's briefly the idea of invalidation, if you still haven't understood so far. So the idea of invalidation in trading refers to the process of evaluating a potential trade idea and determining if it should be disregarded or acted upon. So essentially, it's a way of determining if a trade idea still holds up in light of new information or market conditions. So here's how the process of idea invalidation typically works in trading. So we have the initial trade idea. The trader has an initial idea about a potential trade based on the analysis of market conditions, technical indicators, or other factors. And then we have the evaluation of the idea. The trader then evaluates the idea by looking at current market conditions and other relevant information, such as economic data, to determine if the initial trade idea still holds up. Next, we have invalidation criteria. So the trader then establishes criteria for invalidating the trade idea, such as specific price levels or market conditions that would cause them to reconsider the trade. Next, monitoring. So the trader will then continue to monitor the market and the security in question to see if the invalidation criteria are met. And lastly, we have the invalidation. So if the invalidation criteria are met, the trader may choose to exit the trade or adjust their position. On the other hand, if the criteria are not met, the trader may continue to hold the position or add to it. So in short, idea invalidation is a crucial step in the trading process to help traders like yourselves make informed decisions about their trades and avoid potential losses. Okay, here's another example. So we have our entry here at the swing low and our take profit at our first resistance level. So we're expecting price to rise from our entry to our take profit while keeping note of some of these Fibonacci levels over here. Okay, so when deciding where to place our stop loss, we decided to place it beyond the 127.2, which lies in line with the negative 27.2% Fibonacci expansion. And we place our idea invalidation right above that. So you can see price actually broke out of our entry and headed towards our idea invalidation or stop loss. But thanks to our idea invalidation, it prevents us from being stopped out. So what do? We move our take profit towards our entry. And then we see that we actually make break even over here. So we get out at break even. So if we didn't do that, if we didn't change at our take profit, change our take profit to our entry, we would have gotten stopped out because price would have continued to go down towards our stop loss. Okay, now we have trailing stop loss. So this brings us to our last point in risk management. So if you're still a little bit confused, don't worry too much. Feel free to let me know if you have any questions in the chat. But this is all part of our series on trade management, but I just kind of compiled all of it into this webinar because I found that it was pretty helpful as a beginner trader and it's pretty relevant for if we're talking about mistakes that new traders make and risk management strategies as well. Okay, so we have trailing stop loss, which is the last part of our risk management. So trailing stop loss is a type of stop loss order that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So here's how it works. Excuse me. Let's say you buy a stock at $100 and you set a trailing stop loss at $10. So as the stock price rises to $110, the stop loss will follow. Now at $100, 110 minus $10. So if the stock price drops to $100, your stop loss will trigger, selling your position and protecting your profits. So the trailing stop loss technique can be a useful tool for traders because it allows them to manage risk and lock in profits dynamically as the market moves. This is different from a fixed stop loss, which is a set which is set at a specific price and does not change as the market moves. So it's important to note that the trailing stop loss is not a guarantee that you will exit a trade at the desired price. So market conditions such as gaps or rapid price movements due to volatility can trigger a stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trailing stop loss in combination with a solid risk management strategy, so such as those that we've mentioned previously. Okay, here are some just a summary of the different methods that you can use for trailing stop loss. So here the first that we have is the moving average indicator. Next we have the parabolic SAR, and then we have the chandelier and ATR indicator, support and resistance levels, and then the last we have a combination of all of these methods. Okay. So here is an example of you using the moving average trailing stop loss. So sell entry is over here at our green highlighted circle. And you can see our trailing stop loss is triggered once price hits our moving average indicator. So it's pretty straightforward. You're just basically making use of the indicator to get out of a trade. So it's pretty convenient for traders who don't want to keep staring at your computers all day. This is an easy way to manage your trades. Okay, and it's a good thing that price stopped us out here, because we would have made more losses if price continued to rise over here, which is exactly what had happened. Okay, next we have trendline breakout. So if we're looking at the same example, but with a different technique now. So here we have a trend line, a descending trend line, and just for recap, make sure that for a valid trend line, we have 3 touches. So if we're looking at a descending trend line, we want to make sure that there are 3 significant touches on the bottom, on the underside of the trend line. So not over here, but over here. Okay. So once again, once price touches, or rather breaks out of the trend line, then we are stopped out. So that's just, it's pretty straightforward. That's how trend line breakout works. Okay, and next we have parabolic SAR. As price touches the indicator, we are stopped out. So it protects us from large movements such as this, and it ensures that we still maintain any not losses. Sorry, can you guys see my screen? Okay, I'm not so sure what just happened. Okay, yeah, I'm not so sure what happened, but okay, we're back now. Can you see the screen now? The shared screen? Okay, thanks, Moses. Okay. Yeah, I don't know what happened. Okay, anyway, so sorry about that. Okay, so similarly, what was I saying? It protects us from large movements or large reversals such as this that can hit back towards our entry and we can end up losing all of our profits that we made throughout this area here. Chandelier and ATR trading stop loss. Even though this looks a little bit more complicated, but the idea behind it is basically still the same. We are stopped out when price breaks out of these indicators. Okay. Here's another example of moving average on another example now because previously we were looking at the same chart. So now we're looking at a different chart. So same thing, moving average, you can see we stopped out right when price breaks out of this moving average indicator. Okay. Using breakouts as trading stop loss. So breakouts are usually high volatility events, and price can spike up and reverse almost as quickly. So stop loss can help you manage risk, protect capital, and the trailing stop loss can help you protect your profit. So here we have the parabolic star. And this is in combination with support and resistance levels. We're just showing you how you can combine these to identify any breakouts. So I'm just going to go through this pretty quickly. Okay, next we have overtrading. So you got to trade to make money, not trade just for the sake of trading. I'm not going to get into this because it's pretty self-explanatory. It's just basically trying to say that some traders, especially when you first start, you get a bit excited and you simply forget about profits and you're just looking at the movement of price. So you want to make sure that you protect your capital and make sure that you just implement all of the risk management techniques that we talked about in this webinar so that you protect your capital and make sure you remember that you are still here to make a profit and not trade for the sake of trading because it's pretty time consuming as well. Okay, lastly, well, not lastly yet, but second lastly, we have ignoring fundamentals. So let's introduce FX news calendar or an economic calendar. So here I have screenshots from two websites that provide information on FX news or major news events that can impact the markets that you are looking at. So on the right, I have Forex Factory, and on the left, I have investing.com. So having a news calendar that you look at is pretty important because it allows you to see at one glance all important economic data releases. And it shows key events such as GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. So it's important to distinguish between microeconomic and macroeconomic activity. So some news may impact a particular city such as Tokyo in Japan or Dallas in the US. In other circumstances, a country like Germany may benefit or be hindered by economic news more than its neighbors. So extending further out, an announcement by the ECB is likely to have a greater influence on Eurozone markets than those of African nations. So this helps us keep track of the leading economic index or range of composite indexes such as the coincident index of major economies. So we want to use the information at hand to help us to gauge the economic sentiment and volatility levels of the instruments that we're trading. So I'm just going to briefly introduce some high impact events and what exactly they mean, because these are pretty common when you're looking at major events from all of those FX websites. So FOMC meeting is also known as the Federal Open Market Committee, and is US Fed's way of communicating their view on monetary policies. Fed interest rate decision normally comes together with FOMC meetings, and if Fed is dovish, that means that the USD is bearish. If the Fed is hawkish, the USD is bullish. If interest rate goes up, the USD is bullish, and if interest rate goes down, the USD is bearish. Okay. NFP or non-farm payroll measures the change in citizens that are employed from the previous month, which excludes the farming industry. Unemployment rate measures the total unemployment of workforce that is seeking active employment from the previous month. Okay, next we have crude oil inventories. These measure the weekly change in the amount of crude held by the US firms. So if crude inventories increase, oil prices should drop. And EIA stands for Energy Information Administration, and it's a short-term outlook. So it's a monthly forecast for the year ahead, the demand and prices across major fuel types. So I mentioned earlier some benefits of using FX Calendar, but depending on the individual's trading style, it can help you to plan trades and allocations for the day or week or month ahead, and also help to alert you on upcoming important news that may affect volatility in whatever markets that you are trading. Okay, lastly, a trading journal. This is particularly important if you are a beginner trader. So here's just a brief run through of, or checklist perhaps, of how to set up your own trading journal. So it's a relatively straightforward process. Firstly, you choose a format. So you can decide if you want a physical notebook, a spreadsheet, digital document, or even a specialized trading journal software. Next, we decide on the categories. So can be the date and time of the trade symbol, entry and exit prices, position size, stop loss, take profit levels, trade duration, and trade outcome. So you can also include additional categories if you wish, such as your emotional state, market conditions, trade rationale, so on and so forth. Third, we capture trade details. So we want to record the relevant information for each trade you make. So you be consistent and diligent in entering the details accurately and promptly after each trade. So you want to make sure that you include all the predetermined parameters, such as entry and exit points, as well as any adjustments made during the trade. Okay, fourth, analyze trade performance. That's pretty self-explanatory. So you basically just look for patterns, trends, and areas for improvement, and reflect on any winning successful trades or any losses. Okay, reflect on emotional factors, review and adapt. So you learn from your past traits and experiences, and continuously adapt and evolve your strategy based on your journal analysis. And it's also really important because it helps you to maintain discipline. So it helps you to stick to the discipline by recording each trade and consistently updating your journal. So it contains all the necessary information and to help you maximize the benefits of maintaining a trading journal. Okay, so using a trading journal offers several advantages. I'm just going to briefly go through this. Firstly, we have performance analysis, which allows you to analyze your trading performance in a systematic and objective manner. So same thing, we mentioned this earlier, so I'm not going to get into that. Learning and development. So basically reflect on your decision-making process, identify errors or missed opportunities, and then learn from your experiences. Emotional awareness. This is pretty important, especially when you're just starting out. In a volatile market, emotions can significantly impact your trading decisions. So when you track and analyze your emotions during different trades, it can help you to be aware and identify your emotional biases, such as fear or greed, that may lead to impulsive or irrational decisions. Next, we have risk management. Okay, we went through this already, so I'm not going to touch that. Trade planning and execution. We talked about that as well. Accountability and discipline. Yeah, we mentioned that as well. And confidence building, which we mentioned is similar to having a trading plan. So boost your confidence by documenting your successes and learnings, and you can review your progress and build confidence in your trading abilities. So in conclusion, using a trading journal or trading plan provides numerous advantages, but you also have to be sure that you use everything in conjunction with a strong risk management plan and strategy. Yeah, and it can help you to enhance your skills and refine your strategies and achieve long-term success in the markets. Okay, that brings us to the end of today's webinar. Thank you guys so much for joining me today, and I hope you guys found it helpful. All the best in your trading journey and have a great week ahead. Bye, guys.